you spot the perfect bullish engulfing pattern. Support is holding, the RSI is oversold, and you hit buy. 10 minutes later, a sudden 200 pip drop wipes out your stop loss, just before the price reverses exactly where you thought it would go. These logic-defying moves are not market errors. They are engineered liquidity traps. Institutional traders require massive volume to fill their orders, and they find it by triggering the stop losses of retail traders who are all looking at the same technical levels. Because gold is a highly liquid global asset, standard chart patterns often serve as breadcrumbs for larger players. Relying on the same technical analysis you use for currency pairs like Euro-USD often leads directly into these traps. Survival in the XAUUSD market requires looking completely off the chart. To understand why these moves happen, you have to monitor the invisible macroeconomic forces that drive institutional capital. Navigating this volatility requires an institutional framework, one that uses macro data to filter out low probability signals before you ever look for an entry. Gold is a non-yielding asset. It doesn't pay dividends or interest. This makes its primary competitor the U.S. Treasury market. When the return on government bonds shifts, institutional money moves. The metric to watch is the 10-year TIPS, the Treasury inflation-protected securities. This represents the real yield, or the interest you earn on cash after accounting for inflation. This chart shows the inverse correlation. When real yields rise, gold falls. These central bank-driven structural shifts create broad trends. If you see a technical buy signal, but TIPS yields surge, it's a trap. Macro headwinds will almost always override the technical pattern. Gold's second major driver is its relationship with the US dollar index. Because gold is priced in dollars, they usually move in opposite directions. The exception is a positive correlation break. If the dollar and gold are both rising, it signals intense global stress. This safe haven behavior typically creates sharp parabolic spikes as capital flees to quality during a crisis. By prioritizing these yields and dollar correlations over basic support lines, you can discard high-risk setups before ever putting capital at risk. Once the macro filter confirms a direction, you need to identify when the market has enough institutional volume to actually move. The most critical period begins at 1300 GMT. This marks the window where London trading desks are closing their books for the day. This overlaps with the New York Open, creating a 4-hour power hour of peak liquidity. This is when the largest orders are filled and the most significant intraday price action occurs. Institutions use this high-volume window to perform liquidity sweeps. They push the price just past major round numbers, like $2,300, to trigger retail stop losses and fill their own large buy or sell orders. To avoid being part of that sweep, you can front-run the level. If bullish at a major round number, place your entry 20 to 30 pips above it. This ensures you are filled alongside institutional orders, rather than being stopped out with the crowd. Even with correct timing, gold's volatility is unique. A 100-pip move is standard daily noise, which can easily destroy accounts using rigid small stop losses. To manage this, set your stop losses based on the average true range, or ATR. Using a multiplier of 2 times the ATR gives your trade enough room to survive gold's signature intraday spikes. Combining the London-New York crossover timing with ATR-adjusted risk scaling prevents you from being shaken out by gold's regular market fluctuations. Moving from a pure chartist to a macro-technical hybrid means you no longer have to guess why the price is moving. You are trading a physical asset that responds to the shifting cost of money and global risk. Use the drivers we identified to dictate your trade duration. For fear trades caused by geopolitical shocks, look for quick scalps during spikes. For debasement trades driven by falling real yields, look for swing trades that can last for weeks. The goal is to move past simple pattern recognition and start forecasting market moves based on where institutional capital is actually flowing. Open your FXNX terminal today. Overlay the TIPS yield data with your gold chart and look for your first liquidity sweep during